Global financial markets are experiencing a seismic shift as silver prices surge past $77 per ounce, a level not seen in decades, signaling deep structural stress in the international monetary system. The acceleration of dedollarization, driven by nations seeking to reduce exposure to U.S. fiscal policy, sanctions, and dollar volatility, is reshaping global capital flows in real time. Investors and central banks are reallocating assets into tangible stores of value, with silver emerging as a key instrument for hedging against both currency devaluation and geopolitical uncertainty. This sudden repricing reflects more than speculative fervor. It underscores systemic vulnerabilities in fiat currency dominance, industrial supply chains, and cross border liquidity. Markets are now navigating an environment where traditional hedging models, asset correlations, and reserve assumptions are being challenged, creating conditions for heightened volatility and strategic recalibration across multiple layers of the global economy. The current silver rally, which has breached the $77 mark, represents a confluence of industrial necessity, strategic reserve accumulation, and systemic financial recalibration that is unprecedented in scale and scope. Unlike conventional commodity cycles, which are often characterized by transient speculative movements, the present surge in silver prices is anchored in structural realities that extend well beyond short term market sentiment. Industrial demand for silver is non discretionary, driven by its irreplaceable role in critical technologies, including photovoltaic cells for solar energy, lithium ion and next generation batteries, semiconductors, and a range of advanced electronics essential for both consumer and defense applications. The industrial imperative ensures a baseline level of consumption that remains resilient irrespective of price spikes, a factor that fundamentally distinguishes this rally from previous periods dominated by speculative trading. In this context, silver is simultaneously a strategic industrial input and a store of value, creating unique feedback loops that amplify price volatility and stress market liquidity. The supply side dynamics further exacerbate the current price trajectory. Over the past decade, investment in new silver mining capacity has been limited, constrained by a combination of capital discipline among producers, environmental regulatory hurdles, and declining ore grades in major producing regions. This structural underinvestment has left inventories thin, leaving the market highly sensitive to incremental changes in demand. Even relatively modest flows of capital, whether from industrial buyers securing supply for production or from sovereign and institutional investors seeking tangible hedges against currency and systemic risk, can produce outsized price movements. Physical delivery obligations inherent in bullion backed exchange traded funds and futures contracts further intensify pressure on available inventories, creating potential bottlenecks that magnify both market volatility and systemic risk. The thinness of supply relative to both industrial and strategic demand elevates silver beyond a simple commodity into a critical vector of global financial and technological stability. Strategic accumulation by sovereign funds and institutional investors constitutes a second, reinforcing driver of upward pressure. Unlike speculative traders who seek short term gains, these entities are acquiring physical silver for long term balance sheet resilience, portfolio diversification, and hedging against both fiat currency depreciation and geopolitical uncertainty. The scale and durability of these purchases materially alter market functioning. Available inventories are absorbed into long term holdings, effectively removing them from active trading channels and reducing overall market liquidity. This structural scarcity introduces a novel form of systemic risk. The very assets that constitute a hedge against macroeconomic instability are themselves contributing to heightened market sensitivity, with the potential for abrupt corrections in price should a sudden liquidity event occur. Moreover, the emphasis on physical delivery and long term storage distinguishes this rally from prior speculative episodes in silver, where paper instruments and leveraged positions predominated, highlighting the strategic and structural nature of current flows. The interplay between industrial demand and strategic accumulation creates a dual layered pressure mechanism that has wide reaching ramifications across multiple sectors. Manufacturing and technology companies dependent on silver for production are encountering margin compression as input costs rise in real time, a challenge compounded by the volatility in forward and derivative markets. Supply chain planning becomes increasingly complex under conditions of price uncertainty, particularly in sectors where silver is ease. Essential and substitution is either technically infeasible or economically prohibitive. The convergence of high industrial consumption and constrained supply means that incremental demand shocks, whether from new technology adoption, shifts in energy policy, or strategic reserve accumulation, can trigger amplified price responses, a dynamic that has cascading implications for both operational and financial planning across industries. The effects are not confined to commodity markets. They ripple into corporate finance, capital budgeting, and risk management, reinforcing the systemic dimension of the current silver surge. Financial market dynamics are equally impacted. The influx of capital into silver, driven by both macroeconomic concerns and industrial necessity, is reshaping correlations across asset classes. Traditional relationships between equities, bonds, and commodities are increasingly unreliable as investors reallocate toward tangible stores of value, undermining conventional hedging frameworks and risk models. ETFs, futures contracts, and other derivative instruments that rely on adequate physical supply to maintain pricing integrity are experiencing stress, resulting in potential anomalies in valuation and settlement processes. The systemic importance of silver, in this context, extends beyond its market capitalization or industrial utility. It functions as a barometer of confidence in fiat currencies, monetary policy, and the broader stability of global financial networks. The current rally, characterized by persistent accumulation and thin inventories, elevates the potential for abrupt corrections and liquidity shocks, emphasizing that silver is no longer merely a commodity, but a structural lever in global financial stability. Geopolitical considerations further amplify the dynamics at play. As nations seek to reduce reliance on dollar denominated assets and diversify their reserves into tangible stores of value, silver is increasingly positioned alongside gold as a strategic hedge. The ongoing de-dollarization trends, accelerated by sanctions, trade realignments, and cross border financial instruments that bypass conventional currency systems, place additional upward pressure on precious metals. Sovereign purchases, in particular, are designed to be durable and resistant to rapid liquidation, reinforcing structural scarcity and heightening market sensitivity to incremental demand. This intersection of geopolitical strategy, industrial necessity, and market dynamics renders the silver market uniquely vulnerable to systemic stress. Incremental shocks are likely to produce amplified effects across both financial and industrial sectors, with potential ramifications for global liquidity, pricing stability, and risk management frameworks. The technological imperative for silver compounds these pressures. Renewable energy infrastructure, high efficiency electronics, and advanced battery technologies are not optional or deferrable. They represent critical pathways for energy transition, technological competitiveness, and industrial modernization. The necessity of silver in these applications ensures that demand remains robust regardless of macroeconomic cycles, providing a structural floor under prices that is relatively insulated from short term speculative sentiment. When combined with strategic reserve accumulation by sovereigns and institutional investors, this industrial floor underpins sustained upward pressure and introduces a persistent source of volatility. Market participants, therefore, must reconcile the dual role of silver as both an essential industrial input and a strategic asset, recognizing that traditional supply demand paradigms may no longer fully capture the mechanisms driving price formation and market behavior. From a risk management perspective, the current environment challenges conventional assumptions. Industrial consumers face not only elevated costs, but also potential disruption to production schedules, procurement strategies, and capital allocation. Financial institutions and investors must navigate liquidity constraints, pricing anomalies, and derivative settlement complexities. The correlation breakdowns observed between silver, equities, bonds, and currencies necessitate a reassessment of portfolio construction, hedging strategies, and stress testing methodologies. In essence, silver's surge functions as both a symptom and a driver of broader systemic risk, signaling that capital is reallocating toward tangible assets in response to structural vulnerabilities in fiat currency systems, industrial supply chains, and geopolitical risk landscapes. The systemic implications extend across financial, industrial, and technological domains, emphasizing the integrated nature of modern global markets and the cascading potential of asset reallocation under conditions of scarcity. In conclusion, the rally above $77 represents a structural realignment of the silver market with profound implications for industry, finance, and global monetary strategy. Anchored in persistent industrial demand and reinforced by strategic accumulation from sovereign and institutional actors, this surge transcends typical commodity market behavior. Limited new mining capacity, thin inventories, and the dual role of silver as both an industrial input and a strategic hedge have created conditions for sustained upward pressure and heightened volatility. Traditional correlations, hedging models, and liquidity assumptions are increasingly inadequate, while the potential for abrupt market corrections and systemic stress is materially elevated. As capital continues to flow toward tangible stores of value, the ripple effects threaten to reshape industrial cost structures, financial risk management frameworks, and global liquidity networks, marking the silver market as a critical nexus of industrial, financial, and geopolitical vulnerability in the current era. The accelerating de-dollarization trend represents one of the most consequential shifts in the international monetary landscape since the post-Bretton Woods era. Silver's meteoric rise is not merely an isolated market anomaly, but a tangible manifestation of structural shifts in global finance. Over the past decade, the accumulation of fiscal deficits in the United States, coupled with expansive monetary interventions and unprecedented debt issuance, has eroded confidence in the dollar's ability to maintain purchasing power over the medium to long term. Central banks, sovereign wealth funds, and institutional investors are increasingly aware that reliance on dollar denominated assets exposes them to both macroeconomic and geopolitical risk. U.S. policy instruments, including sanctions and trade measures, have further underscored the vulnerability of holding assets denominated in a single, politically aligned currency, creating a strategic imperative for diversification. In this context, silver emerges as a uniquely positioned asset. It is globally recognized, carries no counterparty risk, and remains liquid even in stressed conditions, making it a practical alternative to paper reserves or dollar based instruments. The shift toward non dollar assets is not a symbolic gesture, but a deliberate operational adjustment. Central banks are establishing and expanding currency swap lines with non US partners, allowing for direct bilateral settlements in local currencies. Trade arrangements are increasingly being structured outside the dollar, particularly among economies seeking insulation from US led sanctions regimes or geopolitical leverage. Commodity pricing, including energy and industrial metals, is gradually being negotiated in alternative currencies, signaling the emergence of parallel financial ecosystems that circumvent traditional dollar dominated frameworks. These adjustments have immediate consequences for liquidity. The fragmentation of capital flows into multiple currency corridors, increases transaction costs, reduces market depth in traditional dollar instruments, and elevates volatility in both foreign exchange and derivative markets. The cumulative effect is a redefinition of systemic risk, wherein traditional assumptions of dollar hegemony and uniform reserve liquidity no longer hold, prompting a reassessment of balance sheet resilience across both sovereign and institutional portfolios. From a macroeconomic perspective, the acceleration of de-dollarization has profound implications for global trade and financial intermediation. Exchange rate dynamics are becoming more complex as countries diversify their reserves and alter the composition of foreign currency holdings. The traditional arbitrage and hedging mechanisms that have stabilized cross border capital flows are under strain as non dollar settlement channels introduce new frictions and uncertainty. For multinational corporations, the increasing prevalence of trade settlements outside the dollar demands sophisticated treasury management and dynamic hedging strategies. The sensitivity of international trade to incremental policy shifts, currency interventions, or geopolitical tensions has increased, as exposure is now distributed across multiple less liquid currency markets. These factors contribute to a latent risk of abrupt capital reallocation events, which could manifest in heightened volatility across equities, bonds, commodities, and foreign exchange simultaneously, rather than in isolated markets. The strategic adoption of silver as a reserve adjunct reflects both practical and symbolic considerations. Unlike paper based assets, silver is inherently scarce, globally accepted, and physically transferable. It does not rely on the solvency or policy consistency of any single sovereign issuer, and it is widely recognized in both financial and industrial contexts. Importantly, silver's dual role as an industrial metal and monetary hedge amplifies its systemic relevance. Industrial demand party, particularly for renewable energy technologies, electronics, and defense applications, ensures that silver remains a non-discretionary input in the global economy, thereby limiting speculative manipulation and reinforcing its intrinsic value. This intersection of tangible utility and monetary credibility makes silver a preferred medium for nations seeking to insulate their reserves from the compounding risks of dollar exposure and geopolitical volatility. The cumulative effect is a market increasingly responsive not merely to short term financial signals, but to long term structural considerations regarding monetary sovereignty and financial resilience. The ongoing realignment in reserve management is creating feedback loops that reinforce both de-dollarization and silver accumulation. As more central banks and institutional actors increase allocations to silver, market liquidity is incrementally reduced, further driving price discovery and signaling scarcity. Rising prices, in turn, attract additional capital, which accelerates both hoarding behavior and strategic accumulation. These dynamics introduce a new layer of systemic sensitivity, wherein even moderate policy shifts, geopolitical developments, or industrial demand changes can precipitate outsized reactions in both physical and derivative markets. The interaction between these variables highlights the emergence of a partially self-reinforcing cycle, in which silver prices serve simultaneously as an indicator of currency risk and a driver of market reallocation, creating multidimensional feedback across industrial, monetary, and financial domains. From a geopolitical standpoint, the de-dollarization trend and corresponding silver demand illustrate the erosion of unilateral financial dominance and the rise of multipolar reserve strategies. Nations increasingly view currency diversification as both an economic hedge and a geopolitical instrument, allowing them to mitigate exposure to foreign policy leverage while maintaining strategic autonomy in international trade. This shift challenges traditional power dynamics embedded in dollar-centric financial systems and places pressure on the US and allied institutions to reconsider the durability of policy tools predicated on global reserve dependence. As reserves are rebalanced toward tangible, non-sovereign assets, the potential for strategic coordination among non-Western economies increases, creating new structural corridors of liquidity that are less susceptible to external enforcement or policy influence. The implications extend to trade finance, cross-border lending, and the broader architecture of international settlements, signaling an epochal transformation in global financial governance. Financial markets, accustomed to predictable correlations between fiat currencies, sovereign bonds, and commodities, are now navigating an environment characterized by fragmented liquidity and reallocated reserve assets. Standard risk models, which rely on historical correlations and stable counterparty assumptions, may understate the volatility and systemic risk inherent in this transitional phase. Silver's surge, therefore, is not an isolated market event, but a tangible signal that investors and institutions are internalizing both currency and geopolitical risks in real time. As liquidity corridors diversify and the reliance on dollar dominated instruments diminishes, the capacity for conventional hedges to function effectively is eroded. This implies that markets may experience abrupt repricing episodes, cross asset volatility, and stress events that are more severe than historically anticipated, reflecting the intersection of monetary, industrial, and strategic pressures. The structural shift in reserve management is also influencing fiscal and monetary policy considerations. As central banks adjust portfolios toward silver and other non-dollar assets, interest rate policy, debt issuance strategies, and balance sheet operations are increasingly evaluated in the context of potential currency devaluation and systemic exposure. Sovereign actors are confronted with a recalibration of risk-return expectations for foreign currency reserves, as traditional dollar-denominated instruments may no longer offer predictable safe haven qualities. This necessitates a more nuanced understanding of reserve allocation, liquidity management, and cross-border capital dynamics. Simultaneously, industrial actors reliant on silver, as an input must anticipate volatility, not just in commodity prices, but in the broader financial environment, recognizing that currency confidence and strategic accumulation behavior directly impact operational costs and supply security. In conclusion, the acceleration of de-dollarization, exemplified by silver's extraordinary market performance, represents a profound and multifaceted recalibration of the global financial system. The shift away from concentrated dollar exposure is being driven by structural vulnerabilities in U.S. fiscal and monetary policy, geopolitical leverage concerns, and the pursuit of currency resilience by central banks, sovereign funds, and institutional actors. Silver functions both as a tangible hedge and as a systemic indicator, reflecting the intersection of industrial necessity, monetary strategy, and geopolitical realignment. The resulting fragmentation of liquidity, reallocation of capital, and evolving reserve strategies are creating heightened sensitivity across financial, industrial, and policy domains. This evolving landscape suggests that markets, policymakers, and institutions must prepare for persistent volatility, nonlinear risk transmission, and an era in which tangible assets increasingly define systemic stability and strategic financial autonomy. The implications of this de-dollarization trend extend beyond immediate market movements. Over time, we can anticipate that capital flows will continue to fragment, creating multiple parallel financial ecosystems with varying degrees of liquidity and risk exposure. Silver's elevated role highlights the emergence of an asset class that is simultaneously functional, strategic, and monetary, capable of transmitting macroeconomic signals across borders and sectors. Institutions that fail to account for this evolving dynamic may find traditional hedging and risk management frameworks insufficient, as the correlation structures underpinning equities, bonds, and currencies become increasingly unreliable. This ongoing shift underscores the need for proactive policy planning, enhanced market surveillance, and a recognition that the financial world is entering a phase in which non sovereign, tangible assets such as silver will play an increasingly decisive role in the determination of global stability, liquidity, and reserve power. The long term strategic consequences are equally significant. As de-dollarization deepens, it may incentivize further coordination among non Western economies in reserve management, trade settlements, and commodity pricing. The growing emphasis on silver as a systemic hedge could influence investment strategies, sovereign reserve composition, and industrial procurement policies worldwide. Moreover, the interaction between industrial demand, geopolitical risk, and reserve diversification creates feedback loops that are likely to sustain elevated silver prices and market sensitivity over time. In aggregate, these dynamics indicate a structural transformation of the global financial ecosystem, in which reliance on the US dollar is gradually supplanted by a diversified network of tangible, liquid assets, fundamentally altering the mechanics of international capital flows, liquidity, and systemic risk management. The current trajectory suggests that the role of silver, both as a monetary hedge and industrial staple, will continue to expand, creating new benchmarks for asset allocation, reserve diversification, and policy coordination. Its function as an instrument of financial autonomy for central banks and sovereign entities is becoming increasingly pronounced, reflecting a broader strategic imperative to mitigate exposure to concentrated currency risk. As markets adapt to these pressures, the interplay between industrial consumption, reserve accumulation, and geopolitical considerations will likely produce sustained volatility and heightened sensitivity to policy developments. The systemic ramifications of these shifts extend across capital markets, trade settlements, and cross border financial operations, marking a transformative period in which de-dollarization, industrial demand, and precious metals are converging to redefine the architecture of global financial stability. The rapid accumulation of silver in global markets is emerging as one of the most consequential indicators of systemic financial stress in decades. While individual price spikes in commodities can often be attributed to temporary supply demand imbalances, the current silver rally represents a confluence of industrial necessity, strategic reserve diversification, and currency risk management, producing structural pressures that extend well beyond the metals market itself. The sheer magnitude of capital flowing into silver has begun to strain the operational capacities of traditional market mechanisms. bullion-backed exchange-traded funds, ETFs, futures contracts, and derivative instruments, which are engineered under assumptions of adequate physical availability and market depth, are now facing significant logistical and pricing challenges. Settlement delays, delivery bottlenecks, and inventory shortfalls are increasingly common, reflecting the tension between surging investor demand and constrained supply. Unlike other commodities that are primarily consumed in industrial cycles, silver's dual role as a strategic monetary hedge amplifies these market stresses, creating interdependencies that propagate volatility across financial systems. About T. The core of this dynamic is the erosion of conventional correlations between asset classes. Historically, equities, sovereign bonds, and major currency pairs have exhibited predictable relationships with commodities, which investors rely upon for hedging, portfolio allocation, and risk management. However, the unprecedented inflows into silver are decoupling these relationships. Capital is moving away from paper based assets and into tangible stores of value, reflecting a broader loss of confidence in fiat currencies and traditional financial instruments. This reallocation generates unexpected cross asset volatility. Equity markets may react negatively not solely to corporate or macroeconomic news, but to the underlying structural flight into hard assets, while bond yields experience pressure as investors recalibrate risk premia to account for rising tangible asset demand. Foreign exchange markets similarly feel these shocks, as shifts toward silver correspond with hedging of currency exposure, prompting increased volatility in major pairs and smaller currencies alike. In this environment, conventional risk models that rely on historical correlations and linear assumptions are increasingly inadequate, leaving both institutional and retail participants vulnerable to rapid, nonlinear market adjustments. The industrial dimension of silver demand further amplifies systemic stress. Silver is not only a store of value, but a critical input in a broad array of technological and industrial processes, including photovoltaic cells, batteries, semiconductors, and advanced medical devices. As physical supply becomes increasingly constrained due to both strategic accumulation by sovereigns and institutional investors and underinvestment in mining infrastructure, industrial consumers are facing rising input costs and compressed margins. This introduces real economic pressures into financial markets, as companies dependent on silver for production must either absorb higher costs or pass them along to end users, potentially feeding inflationary dynamics. The convergence of industrial necessity and strategic reserve accumulation creates a unique feedback loop. Scarcity drives up prices, which incentivizes further accumulation, which in turn intensifies scarcity. Unlike speculative rallies that can self correct rapidly, this structural imbalance suggests that market sensitivity to incremental shocks will remain elevated over extended periods, producing sustained volatility across multiple sectors. Liquidity stress is another critical dimension. As silver is absorbed into long term holdings and sovereign reserve allocations, market liquidity in both physical and paper instruments declines. ETFs and futures contracts rely on the ability to source physical silver to back positions, and as inventories tighten, the potential for pricing anomalies and delivery failures grows. Financial intermediaries are now confronting a dual challenge: hedging exposures in a market where the underlying physical metal is scarce, and meeting the demands of clients seeking immediate settlement in a context of high demand. These pressures amplify systemic fragility, as liquidity shortages in silver can propagate through collateral chains, margin requirements, and derivative portfolios, creating cascading effects in seemingly unrelated markets. Even minor policy announcements, geopolitical developments, or industrial demand shocks can trigger outsized movements, highlighting the sensitivity of the system under current conditions. The strategic accumulation by sovereign entities and large institutional investors is particularly notable. Unlike retail driven speculation, these actors are acquiring silver for long term balance sheet resilience and monetary hedging. Their purchases are not easily reversible and are often designed to remain outside the market for extended periods, effectively reducing circulating supply and limiting the elasticity of the market to meet short term demand. This creates a scenario in which traditional price discovery mechanisms are challenged. Incremental purchases can produce disproportionate price effects, while sudden liquidity events, such as mandated rebalancing, fiscal adjustments, or geopolitical crises, may trigger abrupt corrections. The interplay between strategic accumulation and market scarcity introduces a novel dimension of systemic risk, wherein even modest perturbations can have magnified effects across financial and industrial systems. From a macro financial perspective, the silver surge underscores the vulnerabilities inherent in fiat currency reliance. As investors and institutions shift capital toward tangible assets, the signals embedded in commodity markets increasingly reflect confidence, or the lack thereof, in monetary systems. Silver, in this context, acts as both a hedge and a barometer. Its price movements provide insight into the pace and scale of currency reallocation, the degree of systemic trust eros, iron, and the potential for liquidity bottlenecks. This dual role amplifies volatility. Markets are reacting not solely to conventional supply demand dynamics, but to strategic portfolio adjustments driven by macroeconomic and geopolitical considerations. The result is a feedback loop in which capital flight into silver exacerbates stress across equities, bonds, and currencies, reinforcing the perception of risk and further driving tangible asset demand. The systemic implications extend into risk management frameworks across the financial sector. Traditional hedging assumptions, built on historical correlations, derivative market liquidity, and stable physical supply, are increasingly unreliable. Investors relying on these frameworks may encounter pricing anomalies, margin calls, and operational challenges as a result of the dislocation between market assumptions and structural realities. Fund managers, treasurers, and corporate risk officers are compelled to reassess exposure across all asset classes, incorporating silver and other tangible assets as a critical element of systemic risk modeling. Stress testing, scenario analysis, and portfolio resilience strategies must now account for the possibility of abrupt, cross asset volatility triggered by factors external to traditional financial metrics, including industrial demand, sovereign accumulation, and currency realignment. Industrial users face similarly acute pressures. The price surge in silver directly impacts cost structures for manufacturers in sectors that cannot easily substitute alternative inputs, including electronics, renewable energy, and specialized chemical applications. Margin compression resulting from higher input costs is compounded by volatility in forward markets, as hedging silver exposure becomes increasingly complex and expensive. For companies reliant on predictable commodity pricing to support production planning and capital investment, the current market environment introduces operational uncertainty that can have ripple effects on supply chains, pricing strategies, and competitiveness. The interconnection between financial and industrial markets in silver emphasizes the systemic nature of the risk. Disruptions are not confined to trading floors, but propagate through the real economy. Liquidity fragmentation is further reinforced by the diversification of reserve holdings and strategic hoarding by non-US actors. As sovereign funds and central banks acquire silver for monetary resilience, less metal is available to commercial markets, intensifying scarcity and elevating the risk of price spikes or sudden corrections. This dynamic creates stress across collateralized lending markets, derivative chains, and cross-border financial networks, as silver functions simultaneously as an industrial commodity, a monetary hedge, and a reserve asset. Any liquidity shock or policy-driven withdrawal can propagate through these interconnected systems, producing amplified volatility that extends well beyond the metals market into broader capital markets. In conclusion, the rapid accumulation of silver is producing a structural shift in financial and industrial systems, highlighting vulnerabilities that extend far beyond commodity pricing. Elevated prices, constrained liquidity, and industrial dependencies are interacting with strategic sovereign and institutional accumulation to create a fragile market ecosystem. Traditional correlations, hedging models, and liquidity assumptions are increasingly unreliable, and the potential for abrupt corrections has risen significantly. Silver's role as a hedge against currency depreciation, geopolitical uncertainty, and systemic risk has transformed it from a commodity into a barometer of global financial stability. As capital continues to flow toward tangible assets, the ripple effects threaten to reshape liquidity structures, risk management practices, and industrial cost frameworks on a global scale, signaling an elevated state of financial vulnerability with broad reaching implications for markets, corporations, and sovereign actors alike.